The ugly question is,
drum roll, please.
I know, how do you prepare for market changes, and how far out do you forecast? Man, that's,
Well, I liked your first answer.
my first, you don't. Yeah. So, I mean, again, I touched on this in our previous episode. Using past data to predict future occurrences, while is helpful, is also skewed, because if you could use past data and the same things were happening again, you would predict the occurrences and correct them before they happen.
That's right.
However, that doesn't happen because different occurrences occur and you can't foresee them because the same things keep happening, but different drivers are forcing them. So how do you prepare for that?
That's right. And I mean, COVID, I think, is a great example of random things that occur. And randomly, we happen to have been at a mastermind event, Freedom Founders, the mastermind event, and they just did it for the trusted advisors. And one of the exercises that they gave us was, you wake up in the morning, the newspaper's at your door, your company has just lost 50% of its business. What are you going to do?
Yeah.
How do you handle it? How do you prepare for that? It was out of the blue. I even remember when they told us to do that, I thought, that'll never happen.
And then 2 months later, yeah,
COVID hits, right?
Yeah. So it's a good exercise to do. How do you prepare? Well, you put yourself in the best possible scenarios that you can with the information that you have in front of you.
Right.
If you're putting yourself in historically higher risk assets that at this particular time are yielding high yield, well, to me, when I look at that, I say, okay, well, that's a historically, volatile asset. And you're in it, and if something volatile happens, you could take a big loss.
Huge.
So just managing where you're at on your portfolio. You want to be in things. We talked about this before.
Talk about the risk.
Yeah,
that you talked
the
about.
risk. You want to be in things that with fair certainty. You can never know everything, but with fair certainty, what your loss level would be, and then on top of that, you have to know, where is my cutoff point? If my loss, I don't predict that I'll ever lose more than 10% on this asset. But if it gets to 12, that's where I cut ties and just run from it. I just say, here, it's gone. It's, so you have to know those points, because controlling your losses helps you control your profit.
That's right. That's right. And I always am shocked at the people who try to hit a home run every time they get up to the plate, because this isn't a home run game. You were talking about numbers. They don't lie.
They tell good stories.
They do. They tell good stories.
You can get, nothing special. Anyone can make a statistic, say whatever they want it to say.
That's right. That's why we have the federal government. Sorry if I hurt your feelings.
Yeah. So, but the data is important. What's more important than the data is to not get lost in it and solely use it to make the decisions current and future.
That's right.
Because that data was created based on occurrences and factors that are no longer, or maybe less likely, or maybe more likely to occur now. The factors have changed, so you can't use that. It's like people trying to predict the stock market, or hey, this thing always does this. It's like, yeah, but what if this happens? Oh, that's never happened.
Neither did 2008.
Yeah, never did 2008. Never did COVID, and I know we could go back to Spanish influenza, but that's
that's pretty deep.
Yeah. but yeah, you use data, but don't get lost in it. I think that's one of the things, like we were talking about someone who was a mathematician, or that's one of the fallacies of that type of mindset, is you look at the numbers and you're like, these are the numbers, these are what it is. And you have to couple that with looking around you and knowing what's happening right now.
That's right.
And, honestly, a little bit of luck and a little bit of intuition.
That's right. That's exactly right. That's exactly right. I said earlier on the other show that we did, I talked about this Facebook post that I thought was really interesting because we're talking about changing markets, and they're always changing. I mean, that's what this business is. Real estate is a changing market constantly. And we want to make sure that we're able to change with it. That's why we're problem solvers. That's what we do. So I have a friend in Collective Genius that posted this question, and I loved it. He said, we've seen a significant slowdown in the market, with some areas having active prices less than the sold prices. Things that would get multiple offers are now sitting for weeks. Anyone else seeing that? Now, this guy is from California, but I really wanted to share some of the answers because people in this Collective Genius are located all over the place. So the first guy says, we've seen a slowdown in Chattanooga, but Knoxville seems to be going strong. Same state.
Yep.
Not even that far from each other. These cities are not that far from each other. Chattanooga is more of a resort town. Knoxville is not.
Knoxville's a college town.
Yeah. Yeah. So Knoxville is still going strong. Chattanooga is slowing down a little. I've always said, and it's from data, but I get this, I'm not just making it up. Resort areas drop first.
Yeah, absolutely.
They go up last, actually, but they drop first.
Yeah.
And they go up quick, like it's more of a straight up.
Yeah.
So you got to be careful in those areas. The other one said, another answer says, we're noticing it slightly in Springfield, Missouri. Still very strong, though. Appraisals are starting to get squirrely. 100%, as another guy says, still a hot market, but definitely signs of cooling down. I like this one too. It says, depending on the property type and location, single family in most areas still going strong, but not getting flooded with offers and showings like they were before. I like that I can see how many showings agents are getting through showing time. That's what we real estate agent use. They act like they've had a lot of activity, but there aren't any showings scheduled. So that what they're saying is that they can actually see what's going on.
Yeah.
And some of the agents don't realize that. Major softening here in Chicago. Showings and offers are drastically dropped. Even some rehabbed properties are not selling, and we're having to reduce the list price. Let me see who else is here. Market appears to have peaked for us in Arizona in March. That's when they peaked. Yeah. Since then, it's flattened considerably, but buyer fatigue has set in. Now, Arizona always tends to be one of the front runners of what's going on. Yeah. Like when 2008 hit, Arizona, California, they were in Florida. They were the places that kind of tanked first. And when they have a comeback, they're the places that come back first. So,
your sand states.
Yeah. So it's something to really keep in mind. Late May seems to be the peak for DC. From somebody else. I like this. It says, it's interesting to hear because I'm hearing about some operators doing apartment syndications in Phoenix, claiming that the market is in high demand for their properties that they are raising capital for. I wonder if their numbers won't be as impressive over the coming years. And then I like this analogy too. We're going to use this analogy, the weather being 110 rather than 120 degrees. Yeah. So it's still good.
Yeah.
It's still good, but it's not like it was.
Yeah. I mean, everything's, relative. I mean, it hit its peak in March, and now it's, it seems to be cooling off. Well, it was at 100 and, like you said, 120 degrees in March, but now it's 110 when, on average it's 90 degrees.
Yeah.
It's like, okay, it's still an up market.
Yeah. Even with all of the things across the nation, we are still short on housing.
And affordable housing. I mean, we've talked about this time and time again. It's, and the supply chain issues, the cost issues have really hammered that.
Right.
I mean, and then one other thing is, I harp on this all the time. People are probably tired of me saying this. You have these capital institutions, hedge funds. I mean, the easiest one to recognize, gets the most recognition, is BlackRock. I mean, they are coming in and they are buying all of these homes. I mean, they are pricing out everyone else.
Yeah.
Because they can, because their cost of capital is way lower. I mean, they can have capital at next to 0%, where, if you and I go out there, we're paying, 7, 8, 9, 10, 12,
Right.
whatever, 15%,
Right,
whatever
right.
it may be. So our cost of capital is much higher. So we're all getting priced out.
Yeah.
And they're doing it because they have the data in front of them that says, millennials aren't going to be homeowners. And then I always think, like, is it chicken or the egg? Like,
Yeah.
Are they not going to be homeowners because they don't want to be, and so they're buying up the properties to rent it out to them? Or are they not going to be homeowners because all the properties are being bought out?
That's right. I also heard that millennials are the biggest buyers right now too.
See, and that's not true.
Huh.
So the biggest buying pool right now,
I wonder if it's where you're located.
I don't know. The biggest buying pool right now are 65 and older. That is the largest buying pool there is. Millennials
buying pool, but are they buying the most?
Yeah, absolutely.
Okay.
Yeah, they're buying the most. And millennials, like, everyone's catering a lot of stuff to millennials, but they're not buying. Well,
because they like the experience.
Well, I mean, the experience could be it, but it could also be, housing has increased in price. Rates are slowly rising, and most millennials are straddled with more debt than the previous generations.
School loans.
So their DTI doesn't work
Yeah.
for conventional loans.
Yeah, that's a very good point.
Like, what's your average millennial have in college loans? I don't know, probably 20, 30,000 at least.
Yeah.
With the prior generations didn't have that.
Yeah. And you think about what they've been through, from what they've seen real estate do, when they can, really remember what they're seeing. They saw their parents go through 2008.
Yep.
And really lose a lot.
Mm-hmm.
And now they're kind of going through something similar.
Yeah.
With the way the home prices are right now, just understanding that real estate to them seems really volatile.
Yeah, it definitely could. I mean, psychological, that'd be an interesting study. I don't know if they've done that, but that'd be an interesting one to know, is the psychological effect on home buying of millennials.
That's right.
Yeah, that'd be interesting.
To wear a mask or not
to wear a mask or not to wear a mask.
That would be the good study.
Yeah.
It's trying to figure out how you're going to adjust what you're doing for the market is, what do you do? I think everybody's going to have a little different way that they approach it, but we've been saying this over and over again, and that the affordable housing is really almost recession resistant.
It's definitely more so than higher houses, higher priced houses for sure. Luxury homes. I mean, yeah. It's like, what do you do to forecast out what you need to do in this market? And kind of what I think is, and this is my personal opinion, I hear people all the time telling me, hey, you need to sell your rentals, cash out of them, and really build up that capital stack. And I'm like, okay, then what? Like, so I have to think that the analysts for BlackRock and for all these other hedge funds are smarter than I am. So
I know that kills you to think that, though.
Man, no, that's you always want to be in the room where you're not the smartest. So they see the data. They know that holding these rentals are a good thing. So I would argue, keep all your rentals. Keep all of them. Like,
how can it hurt?
I mean, how can it hurt? Okay, so you have your rental, you do a cash out refinance, you keep it 75% or lower LTV, you get a little bit of cash. Yeah, it's gonna be less than you did if you sold it, but now that cash is tax free.